Okay, James, PMI, private mortgage insurance. A lot of people might not even realize that they're paying a little bit extra every month for mortgage insurance. So, do you want to talk about what that is and how to get rid of it?
Sure. So typically, sometimes you can get rid of PMI a number of different ways. First and foremost is if you feel that you have the actual rule is 22% equity in your home, you can call the servicer, the person that you're currently making your mortgage payments to, and request that PMI be removed. That's definitely the easiest way to go.
And that's at least 6 months after the loan in most cases.
Typically is after, depending, it depends on your loan to value. So
Okay.
typically when you close, your amortization schedule will show when that PMI is going to drop off.
Oh, okay.
So if you're putting a low down payment, let's say 3 to 5%, that typically is not going to happen for about 9 years. All right.
Okay.
So, but let's say you bought your house with 5% down, and then subsequently over the next couple of years, you put 50 grand to work into the property. So you have built up equity that you didn't have obviously when you purchased a home, plus appreciation just from market gains. And so, I would say rule of thumb is probably after 2 years.
Okay.
You can, look to get to make that request. But once you reach that number, as far as the amortization schedule goes, then it will automatically drop off. Now, if you're in a situation where you have a higher interest rate, or you started at a 30-year mortgage, for example, and you have PMI, and you believe that you no longer should have PMI, and also would like to reduce the term of the mortgage, because when you look at your note rate, right? For example, let's say you have a 30-year fixed mortgage at 4%, but you have $250 worth of PMI. Your APR is going to be somewhere probably north of 4.5%. So now, obviously, PMI is to protect the lender. It does nothing for you as the consumer. It protects the lender from default because they gave you that extra leverage, right? So if you're comfortable with the payment, then it makes sense to look at doing a refinance into a shorter term, which would in effect keep the payment roughly the same, but now you're just accelerating the payment schedule and paying off the loan faster.
Gotcha. So that was a little complicated for me, but
Okay.
basically what I'm hearing is a lot of people are who have been in their home maybe 2, 3.
Yep.
If you've been in your home 9 years in a 30-year fix, it's probably a good time, and
Yep.
you might be paying an extra 50, $200 a month
That's right.
that you don't need to be.
Absolutely. Or even if you've only been there 2, 3, 4 years, and like I said, you did some work to the property, market appreciation, you know now what your neighbors are selling their houses for, and you know how much you bought your house for. You may not get rid of PMI completely, but you may get a much lower factor of PMI. And so you've had your house for 3 years. Market appreciation, I think, on average over the last 3 years nationally has been somewhere around 6 to 8%.
Right.
So if you've had those gains in your property value, and now maybe you could look to go into a 20-year mortgage, and whether you get rid of the PMI completely, because remember, PMI is based on your credit score and loan to value.
Right.
So now let's say you bought your home at 5% down, you were at a 95% loan to value, and now maybe you're at 90% loan to value. So that mortgage insurance factor is going to be less, and also reducing the term. Your payment may be the same, but now I just knocked off 7 years of payments.
Okay. So almost anybody who's gotten a mortgage more than a year or two ago, it makes sense to call your mortgage guy and just say,
Absolutely.
hey, can you take a
Especially
look at
if you
this?
go back and you look at the period, I would say even roughly about 4 or 5 years ago, if we remember the term, taper tantrum in 2013, where from May to July, interest rates jumped up dramatically. And then I would also say the period of the election last year where, interest rates, jumped up dramatically after the election that, interest rates, I remember in 2013, they jumped up to like 4.5% on a 30-year fixed. A 20-year mortgage today is still closer to, 3.75, 3.625, right? So it's about 0.75% less of an interest rate. Now, over the last 5 years, you definitely have had market gains and values nationally that now your loan to value is less. We can get you into a 20-year fixed mortgage, let's say, keep your payments roughly the same, reduce that PMI, but now we just knocked off 5 years of payments.
And the process isn't as hard as when you bought your house, right?
Absolutely. Refinance is much, much, much easier.
The underwriter is going to be a little easier on you.
Yeah, well, because you have the history there.
Right.
There's no inspection issues. There's no negotiating with the seller. It's just going to be strictly a quick application. The average refinance takes 30 days or less.
Great. So this is really worth doing. Could be a big financial move for you. Call Bond Street Mortgage.
Absolutely. The PMI, again, protects the lender, does nothing for you as the consumer, other than obviously it affords you the leverage of putting the less than 20% down. But why continue to pay that? Again, your economic situation has gotten better. Your income has improved. Your property value has improved. So I would say if you've owned your home and you have PMI and you're you've owned your home for at least 2 years and you've had PMI, it definitely is worth just to have it checked to see that you can reduce that expense.